Have you ever looked at your ETF statement and thought, wait a minute, where's the big tax bill? You know, the kind that always seems to hit mutual funds. Well, you're not imagining things. There's a secret, a kind of financial magic trick happening behind the scenes. And today, we're going to pull back the curtain on this billion-dollar secret that makes ETFs so incredibly tax efficient. All right, let's get into it.
Okay, first things first, let's just look at the numbers, because they tell the whole story. On the one hand, you've got mutual funds. Over half of them, 53%, had to stick their investors with a capital gains bill over the last 5 years. You know how it works. The fund sells a stock for a profit, and boom, you get the tax bill. But then look at ETFs, just 16%. That is not a small difference, right? That is a massive gap. We're talking about real money that either stays in your pocket or doesn't.
And this isn't just some abstract concept. Let's look at a real-world example. A tough year like 2022. The market was tanking, right? But get this. Large-cap mutual funds still had to distribute $31 billion in taxable capital gains. Think about that for a second. Your investment is going down in value, and you're still getting a tax bill for it. I mean, that's just adding insult to injury, and it's a very real pain for a lot of mutual fund investors.
So, that leads to the big question, the mystery we're here to solve. How on earth do ETFs manage to dodge this bullet so consistently? What is their secret?
Well, the answer has a fancy name, in-kind redemption. I know, it sounds a little technical, but trust me, the idea behind it is actually pretty simple and kind of brilliant. It's the core of this whole thing, so let's unpack it.
So to get how this works, you have to meet a key player that most people have never even heard of, the authorized participant, or AP for short. Now, think of the AP as the ETF's exclusive business partner. They're these huge financial firms, and their main job is to make sure the ETF's share price in the market stays super close to what the fund's actually worth. They're the only ones allowed to create or redeem large blocks of ETF shares directly with the fund. And this role, it is everything when it comes to the tax magic.
And here's the crazy part. This isn't some brand new loophole that someone just discovered. The whole system is built on a tiny little piece of the U.S. tax code, Section 852b6, that's been on the books for decades. All it says, in simple terms, is that if a fund swaps property, like actual shares of stock, instead of cash to redeem its own shares, then no taxable gain is created for the fund. That one sentence, that's the legal linchpin for this entire strategy.
Okay, so let's walk through how this actually plays out. Imagine an ETF is holding a stock that's gone up a ton. The fund wants to sell it. Now, a mutual fund would have to sell it on the market, create a big capital gain, and pass that tax headache on to you. But the ETF, it does something different. It gets a call from an AP who wants to redeem a huge chunk of the ETF's shares. Instead of handing over cash, the ETF says, here, take these appreciated stocks instead. It's literally a swap. It's the difference between selling a rare baseball card for cash, which is a taxable event, and just trading it for a bunch of other cards. No cash ever changes hands. And the golden rule is, no sale, no tax.
And just how big of a deal is this? Well, get a load of this number. In a single year, the top 25 equity ETFs used this exact method to get rid of stocks that had a combined $208 billion in built-up gains. That's $208 billion that, for tax purposes, basically vanished into thin air. It was never recognized, so it never landed on anyone's tax forms.
But wait, it gets even more interesting. Because Wall Street is really good at taking a useful feature and turning it into a powerful, high-octane strategy. What started as a passive way to handle redemptions has now been weaponized into something called the heartbeat trade.
So what is the heartbeat trade? It's basically taking that in-kind redemption process and putting it on steroids. This isn't just about passively managing inflows and outflows anymore. Oh no. This is a very deliberate two-step dance between the ETF and an AP. The entire goal is to surgically target and remove the most highly appreciated stocks, the ones with the biggest potential tax bombs attached, and just wash them out of the portfolio, completely tax-free.
And it's called the heartbeat trade because it has this distinct two-part rhythm. Beat 1, the infusion. An AP shoves a huge amount of assets into the ETF. Then, a few days later, beat 2, the outflow. That very same AP turns right around and redeems all those shares, pulling the assets back out. But, and this is the key, when they pull the assets out, the ETF pays them with those specific low-basis stocks it wanted to get rid of. So it's in, out, a perfect coordinated pulse. And poof, the ticking tax bomb is gone.
Now, this strategy is so precise and, frankly, so aggressive that it's starting to draw some serious criticism. Some legal experts are not fans. Professor of law Jeffrey Colon doesn't mince words. He calls it a tax pathology. A pathology, like a disease. He argues it's an illness that has grown from that one little line in the tax code we talked about. That tells you just how heated this debate is getting.
So, all of this leads us to the big debate. We've seen how it works, but what do we call it? Is this an ingenious feature that benefits investors? Is it an unfair loophole? Or is it just the future? This really gets to the heart of a huge argument about what's fair when it comes to taxes and Wall Street innovation.
Okay, let's look at the two sides of the coin. The argument for it is pretty straightforward. This is a brilliant innovation. It keeps costs low and makes investing way more tax efficient for millions of everyday people. I mean, who doesn't want to pay less in taxes, right? But the argument against it is just as strong. Critics say, hold on a minute. This is a loophole, plain and simple. It creates a system where an ETF can rebalance its portfolio without paying taxes, but if you or a mutual fund did the exact same thing, you'd get hit with a tax bill. Is that a level playing field?
And this isn't just some nerdy financial debate happening in a back room. You can't separate this from the much bigger conversation that's going on everywhere right now about wealth and taxes. We're hearing about taxing unrealized gains, about making sure the wealthy pay their fair share. This whole ETF mechanism fits right into that debate about a system that seems to have one set of rules for some and another set for others.
And what are the stakes in real dollar terms? Well, the government's own official scorekeeper, the Joint Committee on Taxation, ran the numbers. They estimate that if Congress got rid of just that one rule, Section 852b6, it could bring in an extra $200 billion in tax revenue over 10 years. A number like that? Yeah, that definitely gets a lot of attention in Washington.
Which leaves us right here with this final thought. In a world that's debating wealth and fairness more than ever, what is this thing really? Is it a work of financial genius that makes investing better for millions of people? Or is it a flaw in the system, a loophole that's just gotten too big to ignore? That's the real billion-dollar question. Actually, it's a $200 billion question, and it's one we all need to think about.